Today, I will present the accounting issue identified in the case study of NTK Corporation Berhad for the financial year ended 31st December 2025, together with the appropriate accounting treatment based on the relevant Malaysian Financial Reporting Standard (MFRS).
Issue 1 Revenue with Consignment Term MFRS 15. Let's begin with the first financial reporting issue, which is revenue with a consignment arrangement under MFRS 15. In this case, NTK delivered goods to Omega Trading Berhad. However, Omega only pays NTK after the goods are sold to the final customer. This means the arrangement is a consignment, where NTK still retains control of the goods. According to MFRS 15, revenue can only be recognized when control of the goods is transferred to the customer. Therefore, NTK should not recognize the revenue immediately after delivery. The goods should remain as inventory until Omega sells them to the end customer. This ensures that the financial statement present revenue accurately and comply with accounting standards. Issue 2. Useful Life of Property, Plant and Equipment, MFRS 160 and MFRS 108. Next is the issue regarding the useful life of property, plant and equipment, which is governed by MFRS 160 and MFRS 108. Ahmad decided to change the useful life of several manufacturing assets without obtaining a proper technical assessment or evidence. The useful life of an asset is an accounting estimate and should only be revised when there is reliable information supporting the change, such as professional engineering assessment or change in the asset condition. Without sufficient evidence, changing the useful life reduces depreciation expenses and artificially increase profit. Therefore, the company should continue using the original useful life unless there is reasonable justification. Any valid change should be applied prospectively. Issue 3. Revenue Manipulation to Increase Employee Compensation, MFRS 15. The third issue involves revenue manipulation, which also relates to MFRS 15. In this situation, Ahmad instructed the accountant to recognize the full revenue immediately after the goods were delivered. However, this was done to increase report profit and maximize employee bonuses, even though the revenue recognition criteria had not been fully met. According to MFRS 15, revenue should only be recognized when all performance obligations have been satisfied and control has transferred to the customer. Recognizing revenue too early misleads users of the financial statement and violates the principle of faithful representation. Therefore, NTK should recognize revenue only when it complies with MFRS 15, ensuring that the financial statement provides a true and fair view of the company's financial performance.
Next is earning per share under MFRS 133. The issue is that NTK issue a convertible debt, basic EPS and diluted EPS because they believe it will not affect earning per share. However, this is not appropriate because convertible debt can be converted into ordinary share, which may reduce EPS in the future. By excluding diluted EPS, investors may get misleading view of the company's performance. According to MFRS 133, NTK should present both basic EPS and diluted EPS, which equal prominence, and disclose assumption and potential dilutive effect in the notes of the financial statement. This ensures transparency and reliable financial reporting. Number 5. Post-reporting bankruptcy under MFRS 110. The issue is that Alphatech, the major customer of NTK, declared bankruptcy before the financial statement were authorized. However, Ahmad instructed the accountant to exclude this information. Under MFRS 110, this is an adjusting event because it provides evidence that the customer were already experiencing financial difficulties at the reporting date. Therefore, NTK should recognize payment of receivable in the financial statement and disclose the event appropriately. This ensures the financial statement present a true and fair view of the company's financial position.
Next, I will discuss and analysis the ethical issue arising from the financial reporting decision made by the director, Ahmad, and the ethical dilemma faced by the accountant, Alia, by using the added concept authority and NIAM N. So, this is our Author 3 application. Alia first observed that Ahmad's instructions were not in line with accounting standards and were intended to hide a major client bankruptcy. She then thought about the possible consequences and realized that following this instruction could lead to misleading financial statement. Alia understood that her professional responsibility as an accountant was more important than simply obeying management orders. Then, she remembered that accountants must act with integrity, objectivity, and ensure that financial information is accurate and transparent. After that, she reflected on the situation and considered reporting the issue to senior management or external auditor. Finally, she felt remorse and discomfort about the manipulated records and decided that the transaction should be reported truthfully.
In this presentation, I will explain how the ADAP framework helps Alia make an ethical decision when she discovered that financial information is being manipulated. First, Alia observed that Ahmad's instructions are inconsistent with accounting standards and ethical principles. She also noticed that important information about a major client bankruptcy is being hidden. Next, she thinks about the consequences. Following this instruction could mislead the financial statement and create inaccurate information for investors and other users. After that is understand, Alia understands that there is a conflict between obeying management and fulfilling her professional responsibility under accounting standards such as MFRS 15, MFRS 116, MFRS 110. Number 4 is remembers. She remembered that professional competence, objectivity, and integrity require financial estimate and disclosure to be supportable, unbiased, and transparent. Number 5 is reflect. After reflecting on the situation, Alia considered the ethical action available to her, such as reporting the issue to senior management, the audit committee, or the external auditor.
Last but not least is remorse. Alia feels remorse because she knows that senior manipulated financial records would be wrong. This motivated her to find a way to report the transaction truthfully.
Next, I will explain the application of NIAM in this case. First is muraqabah or accountability. Alia should remember that God always watching her action. Therefore, she should act and refuse to participate in misleading financial reporting, even if she is pressured by the director. Second is ikhtiar or effort. Alia should make every effort to uphold ethical and professional standards. Although speaking up may affect her probation, it helps protect her career and prevent legal or disciplinary action by the Malaysian Institution of Accountant or MIA. Next is niat or intention. Alia's intention should be to protect the integrity of the financial statement and maintain her professional ethics, rather than helping to mislead investors and creditors. Fourth is ikhtiar or effort. She could gather sufficient evidence, such as the Omega trading, the lack of technical asset review, and Alpha Tax bankruptcy case, to support the correct financial reporting. Finally, amanah or trust. Alia has a responsibility not to only her manager but also to investors, lenders, and the public. She must act honestly and ensure the financial statements are fair and reliable.
Let us now look closer at a critical corporate sector involving Ahmad, who is a director. Ahmad made a unilateral decision to revise the useful life of several high-value assets at NTK manufacturing facility. Crucially, this significant accounting change was implemented without any proper technical justification or independent engineering support. To safeguard financial accuracy, the immediate alternative is clear. The organization must require independent technical assessment before any changes to asset useful life are approved. We cannot rely solely on executive discretion for complex asset valuation. To ensure this does not happen again, we need to strengthen our internal control improvement. Any future changes in accounting estimate must be formally presented and strictly reviewed by the Board of Auditors. This adds a mandatory layer of oversight to the process. Finally, how do we measure and enforce professional integrity here? Moving forward, internal audit reviews must be conducted specifically for all manual adjustments made to fixed assets. Regular Targeted audits ensure total compliance and transparency. Moving on, let's examine the situation involving an accountant, Alia. Ahmad gave an instruction to completely exclude specific information from company financial statement. This directly challenged the company reporting integrity. The immediate alternative and recommended action is report Ahmad's instruction directly to the audit committee. This ensures the issue is escalated to an independent body immediately, bypassing internal conflict of interest and keeping the company transparent. To prevent situations like this from happening again, we are focusing on two core areas. The first one is internal control improvement. We will implement regular employee ethics survey within the department. This gives the company team to safe voice to share their honest opinion about management practice. The second core is in measuring professional integrity. Company must actively monitor the number of financial penalties received due to incomplete reporting. This gives companies a concentrate metric to track and protect their compliance record.
Now, I will be explaining about the reflect of the recommendation on Roman 3. The issue that had been discussed are Ahmad, who decided to revise the full useful life of several high-value assets at NTK manufacturing facilities. The first one is how this prevents recurrence. Recurrence is requiring an independent technical assessment to remove the dictionary ability to manipulate the depreciation. What does it mean? Means from now on, Ahmad or anyone cannot just submit a memo saying, I think this machine will last at least 5 years and get it approved. No. How does it work in practice? An internal or external independent expert such as qualified engineer or industry specialist must inspect the asset, review the maintenance records or compare it with the industry benchmark. That report will become the mandatory evidence for any useful life change. The second one, how does this promote ethical financial reporting? What is ethical financial reporting? Ethical financial reporting is independent oversight to ensure no one can manipulate or estimate the personal gain. What does this mean? When one person has unchecked power and over accounting estimate, there's a temptation or pressure to use that power to hit the bonus target, to impress the investor, and to hide the poor operational performance. And how does it promote the ethics, where this will check and balance, where the expert report is naturally gatekept. The second one is how this ensure continue the compliance with MFRS. Every useful life change must be backed by objective expert evidence and meet the requirement of MFRS 116. What is MFRS 116 actually require? The MFRS 116 require the useful life that must be reviewed at least once each financial year end. Any change in the change in accounting estimate apply prospectively. The change must be based on obstacle, physical wear and tear, and maintenance history industry practice. How the last one for this issue is how this contribute to a sustainable and responsible corporate reporting culture. This will build a sustainable culture where accuracy and honesty are expected. What does this mean in a long term? It is not just about one policy. It's about setting a tone from the top to the bottom. Employee and management learn that estimates are not just toys; they must be justified. Over the time, this will reduce the risk of fraud, misstatement, regulatory fines, and reputational damage. The regular internal audit parts mean the policy also include the periodic reviews of existing useful life and not just when someone want to change them. This means the company proactively checks on whether the current assessments still hold rather than waiting for the manipulation to happen. Moving on to the second issue of our problem, where Ahmad instructed Alia to exclude the information from the financial statement. How? This is where prevent the recurrence. Reporting directly to the audit company remove Ahmad powers to intimidate Alia. And now Alia has a safe and direct channels to report the wrongdoing, which will deter the future unethical instruction from the management. What does this mean? It means that before this, Alia have to go to Ahmad to report her work, or through the normal management change, which will mean Ahmad could intercept, bury, or reliable against the complaint. And the new process are Alia are given direct confidence hotline to pursue the report misconduct straight to the audit committee. And the audit committee is independent of management, where they cannot report to Ahmad. Why does this prevent recurrence? Well, Ahmad now knows that if he tells someone to hide the information, the person can go over his head straight to the board. And even now, Ahmad tries to promote ethical financial reporting. This promote ethical by empowering employees to speak up, and Alias knows she can report wrongdoing without fear, which encourage her an honest report and protect the company integrity. And what does this mean? Ethics is not just about the rule book, it's about the psychological safety. If the employee fears of losing their job, they will stay silent and unethical behavior faster. And how does this build the ethics? Now Alia have a formal protection, means she knows that her report will be taken seriously by an independent people, and other employees will see that the company walks and talk, and they realize speaking up is rewarded and not a punishment. Moving on, over how this ensure the continue compliance with MFRS. The survey have helped the company monitor the health of its ethical culture. If employee feel pressure, the company can invest early to ensure the continued MFRS compliance. Means the compliance isn't just a one-time check, it's an ongoing process. And how does this ensure the compliance of the company? It catch early warning signs before the financial statement are finalized. It create a feedback loop, meaning if misconduct are found, the company can fix the process and not just the numbers. Last but not least, how this contribute to a sustainable and responsible corporate reporting culture. Means this build a sustainable culture of accountability. The company use penalty data to improve reporting practice and protect its reputation. What does this mean? It means a sustainable culture means a bad habits that don't return after the culture crisis is over. It's not about punishing Ahmad once. It's about making sure that no future Ahmad dare to do the same things. And why does it protect the reputation? Where the investor trust the company with a strong whistleblower programs. The regulars are less likely to impose heavy fines if they see the company self-correct, and the employee feel proud to work somewhere that values the true over profits.
I just had to let you know you're